In the last 12 months, MGM Resorts International spent over $1 billion buying back its own stock, not building anything, not renovating anything, not hiring anyone, not improving the experience of a single guest at a single one of its properties. $1 billion transferred from the company's treasury to the accounts of shareholders who sold their shares back to the company at the current market price in a financial maneuver that produces no product, no service, no amenity, and no improvement to the physical reality of the buildings where real human beings are staying and gambling and eating and paying $45 a day in resort fees for gym access they are not using. $1 billion. In the same period, the Flamingo, a Caesars entertainment property sitting on the most valuable corner of the Las Vegas Strip, had guests checking in and discovering there was no hot water in their rooms. Not for a few hours. Overnight. The next morning. The maintenance team was working on it. The water never came. Caesars Entertainment, the company that owns the Flamingo, spent $384 million on share repurchases in its most recently reported fiscal year. $384 million handed to shareholders. The hot water was working on it. This is not a coincidence. It is not a management failure in the conventional sense, where the executives made a mistake and the plumbing suffered as a result. It is the entirely predictable, mathematically rational, perfectly legal output of a financial philosophy that has come to dominate both companies completely, and that philosophy is this. The purpose of a casino company is not to provide a great experience to the people who stay in its hotels and gamble on its floors. The purpose of a casino company is to return capital to shareholders. The hotel guest is the mechanism by which capital is generated. The shareholder is the reason the mechanism exists. Everything that happens between those two facts, including whether the hot water in room 414 is working, is an operating cost to be minimized in service of the capital return that is the actual goal of the enterprise. Understanding why MGM and Caesars pour billions of dollars into share repurchases while their hotels decay requires understanding what a share repurchase actually does and why it has become the dominant form of capital allocation for large American corporations over the last 20 years. When a company buys back its own shares, it reduces the total number of shares outstanding in the market. When the total number of shares decreases, the earnings per share figure increases mathematically, even if the actual earnings of the company have not changed at all. The earnings per share number is the figure that most Wall Street analysts use to value a company, and it is the figure that drives the stock price in the short term. So, when MGM Resorts buys back $1 billion of its own stock, it does not need to grow its revenue or improve its profitability to make its stock price go up. It just needs to reduce the denominator in the earnings per share calculation, and the stock price rises automatically. The executives whose compensation is tied to the stock price benefit directly. The institutional shareholders who own large blocks of stock benefit directly. The retail investors who own shares in their retirement accounts benefit directly. The guest in room 414 who has no hot water benefits in no way whatsoever. The share repurchase became the dominant form of capital return in American corporate finance after the Securities and Exchange Commission relaxed the rules around buybacks in 1982, and it has accelerated dramatically in the decades since. Before 1982, companies returning capital to shareholders did so primarily through dividends, which are direct cash payments distributed to shareholders on a regular schedule. Dividends have a quality that buybacks do not. They create a commitment. Once you establish a dividend, reducing it or eliminating it sends a powerful negative signal to the market about the health of the company. Buybacks carry no such commitment. You can buy back $1 billion of stock one year and zero the next without any negative signal because buybacks are discretionary and flexible and carry no obligation to repeat. This flexibility is enormously attractive to corporate executives who want to return capital to shareholders in bull markets, but preserve the option to redirect that capital when conditions change. And it is completely invisible to the customer who sees only the resort fee going up and the hot water going out. The specific financial structures of MGM Resorts and Caesars Entertainment make the share repurchase logic even more powerful and more damaging to the guest experience than it would be at an ordinary company. Both companies have sold the physical real estate of most of their major Las Vegas properties to real estate investment trusts, MGM primarily to VC properties, and they now lease those buildings back as tenants. This means that both companies are asset-light operators. They do not own the buildings they operate. They own the brand, the management contracts, the loyalty programs, and the operating businesses inside the buildings. But the buildings themselves belong to someone else. For an asset-light company, the share repurchase becomes an even more attractive capital allocation choice because the alternative uses of capital are more limited than they would be for a company that owned its real estate. If you owned your buildings, you would have a natural and obvious use for excess capital, renovating and upgrading the physical property. When you are a tenant, renovating the physical property is more complicated because major capital improvements to a leased property raise questions about who benefits from the investment and how the costs are allocated between the tenant and the landlord. It is easier and more immediately rewarding to shareholders to take the excess cash and buy back stock. The result is a system in which the physical hotels, operated by MGM and Caesars, are effectively being maintained by the minimum required to keep the doors open and the regulators satisfied, while the capital that could be improving them is instead being used to support the stock price. The Flamingo, which is one of the most extreme visible examples of this dynamic, is not decaying because Caesars does not know it is decaying. Caesars has sophisticated property management systems. They track maintenance requests, deferred work orders, guest complaint rates, and every other measurable indicator of physical plant condition. The decision not to invest the capital required to properly renovate and maintain the Flamingo is a deliberate financial decision, not an oversight. The return on invested capital for a renovation of the Flamingo, calculated against the rates that the location can command from the tourist market that books there, does not compete with the return from a share repurchase at a time when the stock is trading below what management believes to be its intrinsic value. The renovation gets deferred, the stock gets bought back, the guest gets no hot water. This calculation is documented in the public filings of both companies in ways that are entirely transparent to anyone who reads them carefully, which almost no journalist and almost no consumer bothers to do. The capital allocation priorities of MGM Resorts are stated explicitly in investor presentations. Return of capital to shareholders through both dividends and share repurchases is identified as a primary use of free cash flow. Reinvestment in existing properties is identified as a secondary use, subject to return on invested capital thresholds that each individual renovation project must clear before the capital is committed. A resort fee generates revenue immediately, in every room, every night, forever, with zero capital expenditure. A hot water system renovation generates no incremental revenue, requires significant capital expenditure, and produces a return only in the diffuse, hard-to-measure form of improved guest satisfaction and reduced complaint rates. By the financial logic of the modern publicly traded casino company, the resort fee wins every time, and the hot water system waits until it fails completely and becomes a liability rather than a discretionary upgrade. The deeper problem, the one that the financial analysts do not model and the shareholder letters do not address, is that this logic is self-defeating over time in a consumer-facing hospitality business. The share repurchase strategy is built on the assumption that the earnings the company is generating are sustainable and that the capital being returned to shareholders is genuine surplus that is not needed to maintain the competitive position of the business. In a manufacturing company or a technology company, this assumption can be valid. If your factory is working and your software is current, returning surplus capital to shareholders makes sense. But in a hospitality business, the physical product is constantly depreciating. The carpet gets worn, the plumbing ages, the furniture becomes dated. The technology infrastructure used by the property management systems, the elevator controls, the climate management, the security systems, all of it has a functional lifespan. And that lifespan is not infinite. A hospitality business that does not continuously reinvest in its physical plant is not generating genuine surplus capital. It is deferring a cost that will eventually come due in the form of emergency repairs, regulatory violations, guest complaints, and negative reviews that suppress demand and require even more discounting to maintain occupancy. The share repurchase is being funded, in part, by borrowing against the future condition of the physical property. and the guest is the one who discovers the loan coming due when they check into room 414 and find that the hot water is working on it. The specific numbers from the publicly available financial statements of both companies tell a story that the investor relations departments would prefer not to be told this directly. Caesars Entertainment, in its most recently reported annual period, generated approximately $900 million in free cash flow after its debt obligations and capital expenditure commitments. Of that $900 million, $384 million went to share repurchases. Approximately $200 million went to debt reduction. The remainder was retained or used for other corporate purposes. The company's stated capital expenditure budget for maintenance and renovations at its existing properties, which includes not just the Las Vegas Strip properties, but its entire portfolio across dozens of states, was approximately $500 million for the year. $500 million to maintain the physical condition of dozens of casino resort properties spread across the country. That averages out to roughly $15 million per major property per year, which sounds substantial until you consider that a single full renovation of a mid-tier hotel tower at a Strip property would cost north of $200 million. The math means that at current capital expenditure rates, a full renovation cycle for the major Caesars Strip properties would take decades, not years. The Flamingo is not going to be renovated. It is going to be maintained at the minimum level required to keep it licensed and occupied, and then it is going to be demolished. MGM Resorts tells essentially the same financial story in its own filings. The company committed over $1 billion to share repurchases in a recent 12-month period, while its capital expenditure budget for existing property maintenance and renovation across its entire domestic portfolio was in a comparable range to what it was spending on buybacks. MGM has the additional complexity of operating some of the most capital-intensive properties in the world, including the Bellagio and the Aria, which require continuous, significant investment to maintain the luxury positioning that commands the room rates and the high-limit gambling action that make them financially viable. Every dollar of capital expenditure that goes to maintaining the Bellagio at luxury standard is a dollar that does not go to upgrading the aging infrastructure at the MGM Grand or the Excalibur or the Luxor. The portfolio is being managed as a hierarchy, with the crown jewel properties receiving the investment necessary to remain competitive at their price point, and the mid-tier and lower-tier properties being managed toward a condition that is technically operational but increasingly difficult to defend as good value at the prices being charged. The Luxor is worth examining specifically because it illustrates the portfolio hierarchy problem in the most visible possible way. The Luxor is a pyramid-shaped casino resort on the southern end of the Las Vegas Strip. It was a spectacle when it opened in 1993, an architectural statement that Las Vegas was going to out-Fantasia itself in every possible direction. Today, it is one of the most obviously dated and poorly maintained major resort properties on the Strip. The rooms, which were designed around the pyramid's inward slanting walls and featured inclinators rather than conventional elevators, have never been fully modernized to compete with the rectangular, conventionally laid out rooms of the newer Strip properties. The casino floor has the feel of a property that receives its capital expenditure budget last, after the Bellagio and the Vdara and the Aria have taken their allocations. The entertainment offerings are inconsistent. The food and beverage options are a collection of mid-tier franchise concepts that feel exactly like what they are. The minimum viable food and beverage program for a large hotel that is not trying to be a dining destination. And yet the Luxor is charging resort fees of $40 or more per night on top of room rates that are not significantly cheaper than properties that are maintained to a much higher standard. The Luxor guest is paying nearly Strip prices for a product that is not being maintained at Strip standards, and the gap between what is charged and what is delivered is being pocketed and redirected to MGM's share repurchase program. The Excalibur, also operated by MGM Resorts at the same Southern Strip location as the Luxor, tells the same story. The Excalibur was designed as a medieval castle fantasy property aimed at families, which was a reasonable positioning in 1990 when the casino industry was briefly convinced that family entertainment was the future of Las Vegas. The family strategy was abandoned within a decade, and the Excalibur has been in an identity crisis ever since. It is not a luxury property. It is not a value property in any meaningful sense, because the resort fees and parking charges bring the effective nightly rate to a level that is difficult to justify for a hotel that has not been meaningfully renovated in years. It is not a family property anymore because Las Vegas explicitly repositioned away from family tourism. It exists in a category that can only be described as stranded, occupying an enormous footprint on prime strip real estate, generating revenue primarily from tourists who booked the cheapest available room on Expedia and were surprised to discover that the cheap room was at the Excalibur. MGM Resorts is not going to spend the capital required to genuinely transform the Excalibur into a competitive product, because the return on that investment does not clear the hurdle rate that would be required to prioritize it over a share repurchase. The Excalibur will continue to exist in its current state until the land it sits on becomes valuable enough for a different use, at which point it will be demolished and the land will be repurposed and the share repurchase program will continue, and nobody on the Capital Allocation Committee will have lost a single night's sleep over the decades of guests who paid resort fees for a product that the company itself did not believe was worth investing in. The executive compensation structure at both companies makes it almost impossible for the people making these decisions to make them differently, even if they wanted to. The compensation packages for senior executives at MGM Resorts and Caesars Entertainment are weighted heavily toward equity-based compensation, stock options, restricted stock units, performance share awards. The instruments that translate company performance into personal wealth for the executives running these businesses are tied to the stock price and to earnings per share, not to guest satisfaction scores, not to property condition ratings, not to employee health outcomes or net promoter scores, or the percentage of maintenance requests resolved within 24 hours. The stock price and the earnings per share, which means that every dollar redirected from a share repurchase toward a hotel renovation is a dollar that suppresses the stock price and reduces the earnings per share, which directly reduces the value of the executive's personal compensation package. The incentive to renovate is theoretical. The disincentive is financial and immediate and personal. The system is not broken. It is working exactly as designed. The design is simply optimized for the wrong outcome, for shareholders rather than for guests, for the quarterly earnings call rather than for the condition of the hot water system in room 414. The institutional shareholders who own the majority of both MGM and Caesars stock understand this dynamic and actively encourage it. The largest shareholders in both companies are institutional investors, mutual funds, pension funds, index funds, and hedge funds that measure their performance against benchmarks and that evaluate the companies in their portfolios primarily on the basis of total shareholder return, which is driven by stock price appreciation and dividends, not by the quality of the hotel rooms. When an institutional investor has a conversation with the management team of MGM Resorts about capital allocation, they are not asking whether the Excalibur has been renovated recently. They are asking what the share repurchase authorization looks like for the next fiscal year and whether the company is on track to return its stated target of capital to shareholders. The guest does not have a seat at that table. The guest is not represented in that conversation by any institutional mechanism. The guest is represented only by the market signal of their own spending behavior, and that signal is being ignored until it becomes so large and so persistent that it shows up in the quarterly revenue numbers, at which point management responds not by renovating the property, but by discounting the room rate to restore occupancy, which reduces the revenue per available room metric without addressing the underlying condition of the physical plant. The honest version of the capital allocation argument, the one that the investor relations department would never put in a press release, but that every senior executive at both companies understands intuitively, is that the hotel product at the mid-tier and lower-tier strip properties has already lost the quality competition. The Bellagio, the Aria, the Wynn, the Venetian, the Cosmopolitan, these are the properties that compete on quality. Everything below that tier competes on price. And if you are competing on price, the rational strategy is not to invest in improving the product, because the customers choosing your property on the basis of price will not pay more for a better product. They will just go to a different cheap property. So you minimize your capital expenditure. You charge the maximum fees that the market will tolerate on top of the nominally cheap room rate, and you direct the resulting cash toward the share repurchase that keeps your stock price healthy and your executives well compensated. This is not a secret. It is the operating logic of a significant portion of the Las Vegas Strip, and it has been for over a decade. What breaks this logic, the only thing that ever breaks it in a market economy, is a sustained and quantifiable loss of revenue that forces the reallocation of capital. The visitor decline of 7.5% in 2025 is the beginning of that signal. The collapse of the middle-class repeat visitor, the loyal gambler who came 4 times a year and now comes once or twice or not at all, is the revenue loss that the current capital allocation strategy cannot explain away as a temporary fluctuation. If the revenue decline is sustained, and if it is clearly connected in the data to the condition of the physical product and the quality of the guest experience, the institutional shareholders who currently applaud the share repurchase program will eventually pivot. Not because they suddenly care about the guest experience, but because a declining revenue trend threatens the earnings per share figure that their investment thesis depends on, and because at some point the share repurchase program cannot sustain the stock price in the face of a genuine business deterioration. When that pivot comes, capital will flow back toward property renovation and guest experience improvement, not because management has seen the light, but because the financial model will finally be demanding it. The question is how long that takes, and how many guests stay in rooms with broken plumbing and no hot water in the interim, and how many casino workers breathe degraded air and receive degraded wages, and how many of the loyal middle-class gamblers who built the Las Vegas Strip with their lifetime of visits decide during that interim that the alternatives are better enough that they are not going back. The guest who discovers that Biloxi treats them better and stops booking Las Vegas does not send a formal notification, they just stop showing up. The desk that logs their absence is a revenue report that takes a quarter to compile, and another quarter to analyze, and another quarter to discuss, and another quarter to produce a response to. By the time the corporation that chose the buyback over the hot water system is ready to change its behavior, the guest has already found somewhere better to go. The market signal is real and it is already being sent. The question is only whether the receiving end is listening before the signal becomes a verdict. The comparison to what the money could have done is not abstract. $1 billion, the amount MGM spent on share repurchases in the period described, could have funded a comprehensive renovation of every mid-tier room in the MGM Grand, the Luxor, and the Excalibur simultaneously. It could have funded the replacement of every aging plumbing system at every Caesars Strip property. It could have funded the restoration of the free parking benefit that was eliminated in 2016, funded the restoration of the comp program values that were gutted in the post-bankruptcy restructuring, funded the retention of experienced host staff who were laid off in the cost optimization exercises of the last decade, and still left enough to begin restoring the 3-2 blackjack payouts that were replaced with 6-5 on the main casino floors. All of those things could have been done. The capital was available. The decision was made differently. The shareholders got the $1 billion. The guests got the resort fees. The workers got the degraded conditions. And room 414 got maintenance working on it. This is not going to change from the inside. The people running these companies are not villains who have chosen the wrong path and could be talked into a better one. They are rational actors operating within a system of incentives that makes the share repurchase the correct choice by every financial metric their compensation package and their board of directors holds them accountable for. The only force that changes the behavior of a publicly traded company is the sustained loss of revenue that makes the current strategy look like a failure by those same financial metrics. Your job, if you want this to change, is to stop giving these companies your revenue until they change their behavior. Go to the places that are investing in the guest experience rather than the stock price. Go to the places that have not sold their buildings to real estate investment trusts and use the proceeds to fund buybacks. Go to the places where the hot water works in room 414, not because maintenance is working on it, but because the operator believes the condition of the room is more important than the earnings per share figure on the quarterly. Call. Those places exist. This channel has found them, documented them, and told you exactly where they are. The one decision that forces MGM and Caesars to put the $1 billion back into the hotels instead of the buyback is the decision to take your money somewhere else. Make it.